Welcome back. You're watching the 80 Money Show with me, Kavita Thapliyal. And as we head into the final days of what has been a roller coaster year for the markets, there is both hope and apprehension of what is to come. What will 2023 have in store for investors and Dalal Street? Will India continue to outshine its global peers? And what are the challenges and opportunities in the year ahead? To answer all of these questions, let's bring on board Nilesh Shah, Managing Director, Kotak Mahindra Asset Management Company. Good evening and welcome to the show, Nilesh. And there's this outlook that you've released for 2023. So the first question has to be on markets are actually at record high current levels. But talking about sectors, which sectors are you think are comfortable in terms of valuation, and which sectors would you be bullish on in 2023?
So first, the markets are at record high level and valuations are above average. It's marginal premium to historical average, but it is above average. That means market is expecting companies to perform like Surya Kumar Yadav. If you score at strike rate of below 100, that won't be acceptable. If you have a strike rate after 30 balls, that won't be acceptable. You'll have to start delivering at more than 100 strike rate from the ball number 1. Now, keeping that in mind, we believe there are certain trends where there could be opportunities going ahead, not in the short term, but over medium to long term. The first trend which is visible right now is revival in consumption. Between October 21 to June 22, listed FMCG companies volume was degrowing. Now we believe it has turned around and there will be positive growth. Can we pick up companies within this sector which will benefit from this positive growth? The second sector where we are bullish is related to investment revival. Like consumption has revived at the bottom and middle end of the society, the same thing is happening in investment, where government was already investing, but now private sector, large, big as well as small, is redrawing capital expenditure plan. Companies which are engaged in industrial engineering and capital goods will be beneficiary of this capex revival. Broadly, these are the two sectors, revival of consumption and investment, on which theme we are looking to invest.
All right, revival of consumption and investment. But then which are those sectors where you are really cautious and you would have your own reasons for that in 2023?
So from a sectoral point of view, sectors like global cyclicals, one needs to be cautious. Global economy is going through a tough challenge and it will have consequences on global cyclicals. But more than the sector, it is the management. If you have a bad management, it's like riding in a boat with a hole. The rising tide may lift the boat for a while, but eventually the hole will sink. So we need to invest in good management in good sectors. That combination will deliver better return to us.
Sure. So this was about the sectors, but then what levels are you seeing on Nifty and Bank Nifty going ahead in 2023 now?
So one, it is always impossible to predict market in the short term. Over long period of time, will equity deliver real return, more return than the inflation, more return than other asset classes like debt and gold? Answer is yes. Now, can next 1 year's return be positive? There is a reasonably good chance. But can next 1 year's return be in double digit? There is a reasonably low chance. In market, you never say never, but you can never predict the market. Our recommendation to investor is please follow your asset allocation. Don't get lured by past performance to invest. Look at the future potential and invest. This is the time where you do keep in mind that interest rates are reasonably high. This is the time where you do keep in mind that equity valuations are at a marginal premium to long-term average. Put your short-term money in debt, put your long-term money in equity, and maintain asset allocation which is suitable to your risk profile.
All right, now India is at the cusp of capex cycle revival, but manufacturing has actually degrown in second quarter. How do you see this panning out in 2023, Nilesh?
Undoubtedly, we believe that despite the degrowth in the September 22 quarter for manufacturing sector and also the October 22 IIP number, there is a reasonably good chance for capex to revive. Capex revival is happening because one, capacity utilization at 75% is now reaching a threshold where entrepreneurs would like to invest. Second, corporate India's balance sheet is fairly strong. It is deleveraged by more than 12 percentage point compared to subprime crisis. Third, banks' balance sheet is healthy. Their NPA levels are at decadal low level and they are willing to extend credit. So you have higher capacity utilization, you have cleaner balance sheet, and you have sufficient credit available. Combination of these three can create revival in investments.
So Indian financial services space seems to be in a sweet spot as foreign investors have made a net investment of rupees 14,205 crores in the sector in November. So do you see this trend continuing?
So we do believe banks will have positive momentum, but what we have seen in last 1 year is unlikely to be repeated in next 1 year. 1 year back, bank valuations were very, very cheap. FPIs has sold aggressively and that had kept the prices low. The banking sector was having single-digit credit growth. Now we have double-digit credit growth. We have FPI selling turning into buying, and we have seen bank stocks moving from cheap valuation to reasonable valuations. So going forward, banking sector will do well in terms of profitability, in terms of growth, but the stock price may not repeat what has happened last year.
In a turnaround story, an improvement in rural sentiment is developing. What is your take on this?
Undoubtedly, rural economy seems to be coming out of the inflation and COVID crisis related hit. The government's allocation towards rural economy has increased significantly. While Kharif season had a slightly lower output compared to last year because of the rain shortfall in northern India, the Rabi season looks to be progressing well. The reservoir water level is 25% higher than 10-year average, which bodes well for the Rabi season. Rabi season crop being successful and government spending more money in rural economy put together can create bottoming out of rural consumption and show positive growth. One positive thing about rural economy is the tractor buying. Consistently year after year, we have seen a double-digit growth in tractor volume. It does show that one part of rural economy is doing reasonably well.
But rural consumption here is still to pick up. Now, do you think it is an area of caution for us?
While the rich and upper middle class consumption is not impacted by COVID, the lower middle class and poor people, which is in majority in India, have been impacted by COVID. They had to probably leverage to survive the COVID crisis, and when normal times came, they were focusing more on repairing balance sheet. Between October 21 to June 22, we did see FMCG companies volume degrowing. We believe somewhere between September 22 to December 22 quarter, we will see FMCG volumes turning positive.
So, strong resilience was shown by retail investors in 2022 and SIPs have also been at record levels. Any sign of slowdown you are expecting, or the strength will continue according to you?
So we believe SIP is on a secular growth trend. However, there is huge maturity in retail investors thanks to the mutual fund distribution community. By and large, in a rising or expensive market, we see SIP minus redemptions and net flows coming down. By and large, in a falling market, we see SIP plus subscription, and more money comes in than the SIP flow. This trend has worked out pretty well since 2020 March. So we believe retail investor has become matured. They know when to go to fifth gear, they know when to go to first gear. And we believe SIP will continue to expand. Totally, we have about 3.5 crore retail investors in mutual fund industry. Majority of them have SIPs. We believe there is potential to grow it 10 times over next many years to come.
Inflation has been a major concern, but first time it has come below 6%. Now, what is your outlook for inflation in 2023? Do you see easing down?
Inflation did remain elevated for majority part of calendar year 2022, but that was more because of global factors. This is first time in our history that for more than a year, American inflation is higher than Indian inflation. That had never happened before. Now, notwithstanding that, we need to ensure that inflation remains near RBI's target level of 4% rather than above it. There is a trade-off between inflation and growth. RBI has walked that balance very well. They have taken away excess liquidity. They have raised interest rates, and impact of that should be visible on inflation as global commodity prices have started easing off. We believe for calendar year 2023 as a whole, inflation will be below RBI's target range at the higher end, below 6%.
Private sector investment is still yet to pick up now. Do you believe 2023 will be a year to look forward to?
Yes, we believe private sector investment is on the cusp of revival. In certain sector like renewable energy, we have already started seeing private investment reviving. There are certain sectors like automobile where because of supply bottlenecks, capex revival will take some time. But collectively, higher capacity utilization, deleveraged balance sheet, and availability of credit from banking system put together will revive private sector in calendar year 2023.
But then, what are the areas of concern and challenges for you in 2023? Let's talk about that now.
So there are 2 or 3 local factors and many of the global factors. One, we need to ensure that inflation remains under check. Second, we need to ensure that consumption, especially at the bottom of the pyramid, gets supported. Third, we need to ensure that private sector investment revives and supports growth in the coming years. The fourth and more important is trade deficit. As India is growing faster than the rest of the world, the gap is funded through trade deficit. We are running trade deficit of about $100 billion more than what we can afford. We can do it for a year or two, but not beyond that. So if we manage revival of private sector investment, if we revive consumption at the bottom end, if we keep inflation below 6%, and if we reduce our trade deficit, I think India growth story will be on a very, very firm footing. From a global point of view, there is Russia-Ukraine situation, there is OPEC cartelization impacting energy prices, and there is US Fed rate which is being raised to control American inflation. Plus there is geopolitical risk. If China does something with Taiwan, will it have material impact on global markets? Answer is yes. So there are more global factors to watch out for, but by strengthening our domestic chink in the armor, we can be more prepared to take on global volatility.
Will India outperform global markets again in 2023, or do you think that due to higher valuations and opening of China, we will see FPI outflows now?
It's very, very difficult to take a call because the heart says that India will outperform global markets. The head says that, look, there's so much of expectation and we have done such a huge outperformance that law of average will catch up. I think it's suffice to say that on a strategic basis, investors will want to invest in India, albeit on a technical basis driven by valuation. people may go to non-Indian markets in CY23.
All right, you mentioned Surya Kumar Yadav kind of strike rate, but which are the sectors you believe relatively have limited downside?
So, when you're talking about safe investment, most people will associate it with lower downside and higher upside. Keeping that in mind, we believe as of today, industrial capital goods, consumption, and some of the good management companies focused on China plus one or Europe plus one opportunity in manufacturing should be outperforming the market in the next year.
Which are the sectors which have already outperformed, which have already performed, but still there is scope of them returning in the next year?
So broadly, the market should still be able to deliver positive return, and hence most sectors in market will deliver positive return. But you must moderate your return expectation for CY23. The gap between debt funds return and equity funds return in 23 will be very, very narrow, just like in calendar year 22. Beginning of 22, very few people would have believed that the equity fund and debt fund return will be almost similar, but that's happening. The same is likely to continue in CY23.
All right, that will be all. Thank you so much, Nilesh Shah, for being on the show and sharing the outlook of 2023 that will help our viewers form their financial portfolio. Thank you so much. And with that, it's a wrap on the show as well. But then I'm leaving you